All right, here we go. Another episode of the Study Wealth Podcast. Hey, everybody. I'm Serge Berger. I'm your host. And today I am going to do a little bit of mea culpa and just basically explain to you how my own machine, my indicator, our algorithmic process completely beat me hand over fist in the first half of 2023 in the markets, and even more so specifically in the second half of 2023. So what I'd like to do, I'll explain to you how this happened and why it happened. It's actually a good thing. It shows that our indicators work very well. But I would like to walk you through a little bit what some of the benefits are of using indicators and more algorithmic processes, and maybe also some of the drawbacks, right? Because there is, to be fair, there's always two sides of the coin. There are also some drawbacks. First of all, let me just kick it off. And obviously for you guys on YouTube, you're going to see these charts. And for those people that are listening to this over on the podcast platforms, you won't miss much as always. I'm just going to show you, I'm going to talk about these charts so you can see them as well. So let me quickly flip on over to the charts here. Give me just 1 second. And here we go. Okay. So what we're looking at here specifically is my algorithm, and it's more than just an indicator. It's a decently complex system that essentially differentiates trends from trades. So it tells us when something goes into a different trend, whether that is a bullish trend or into a new bearish trend or into a neutral trend. And then it gives us bias signals from a trading perspective, right? It's something called the market rover. Maybe some of you, I would imagine actually quite a few of you already are using this tool as part of the Inner Circle membership that we have. What you're looking at here, or for those people that can see it again, otherwise if you're listening, it doesn't make a difference, I'll just talk about it, is NVIDIA. And what we saw, what our algorithm, our indicator did, it actually flipped the stock into a bullish trend back in late February. So around I think it was around $230 or so. It became a new bullish trend. And then that stock ran all the way up to 420, and we got a buy signal somewhere in, I think it was just late April, maybe the first couple of days of May. And from that buy signal, the stock ran from 280 to 440. Big move, obviously. Why am I pointing this out? I'm pointing it out for one, it's nice to know that the algorithm really works. And I have a whole bunch of other examples here. So the point is the algorithm got it right. And me, and this is what I talk about, I get it wrong. So why did I not participate in this? And why did my own analysis basically fight what my indicator was doing? When we look at the markets, we like to look at it holistically. We like to use a top-down approach. So we like to look at macro factors that are driving markets while not discounting some of the more near-term analysis. So when you look at markets, there's obviously lots of different ways of analyzing markets, but basically there are lots of different things that can drive a market through on an extreme basis, intraday or multi-week, multi-month, and even multi-quarter. And markets can be driven in a completely opposite direction to what the broader macro picture is telling us, again, for an extended period of time. And that's actually what happened here. So what I did is, because I'm looking at the markets, and I think factually it's hard to disagree that the tighter money supply, economies are slowing at the margin, some places more than others, they are slowing. But because they were slowing, because I was using too much of a weighting in my own analysis on this global macro factors, and I basically discounted the fact too much how much money was coming into the markets from a near-term perspective. So basically what happened in very simple terms is, yes, I was right about the broader economy. It's slowing. It was slowing slowly, but it's still slowing. That was correct, but I totally got the moves wrong. So what happened is, when we had the SVB, the regional banking, blow up in March, what the central bank essentially did is basically do quantitative easing. So they put money into the system. The Bank of Japan as well, and a whole bunch of other factors. The point is, all that was stimulative. And then you had AI, and of course, everything ended up blowing higher. And what I did is, I just did not weigh those factors enough. But our indicator, our algorithm, in this case, the market rover you're looking at, it absolutely nailed it. And you can see literally in March, as we got SVB, everything's blowing up. Literally just at that point when I would have gotten even more bearish, what this our indicator two, it gave us a buy signal of an NVIDIA, a bullish trend at 230. The stock ended up rallying, of course, much higher. The thing I want to talk about here is the importance of respecting moves in different time frames. And we talk about this all the time to our clients, whether it's at Blue Marlin Advisors, our investment advisory firm, or whether it is on the steady trader side, more so from a research perspective. We try to make sure that we stay within our respective time frames. And I quite frankly just didn't do that. So my own algorithm, my own system, my own indicators just absolutely beat me hand over fist, which is, it's good, right? It's good to know that it's actually capable of beating the person that created it. And lesson learned on my part, yet again, listen to my indicator at least as much as I would to my macro overlay. Give you a couple other examples for those people that are just listening. What I'm showing here on the screen right now is a chart of Oracle. Here too, you can see we got buy signal after buy signal in the high 80s and low 90s. Stock ended up rallying to 100 and the high 120s. Again, I didn't much participate in this because, again, I was just too caught up in the macro overlay. Same thing in Meta. That stock turned into a bullish trend in April. So literally right after SVB, the regional banking crisis, the stock turned into a bullish trend around 200 and whatever, 10-ish dollars. Ended up, of course, running much higher, like up almost like 300 at the time I'm recording this. Again, a trend that essentially I was fighting, right? Just because I just wasn't respecting some of the more nearer term analysis, right? So again, when it comes to more nearer term analysis, there's things that can go counter the economic cycle. So the economic cycle doesn't lie, right? The economies accelerate, they slow down, the whole thing. That's the typical cycle. But within those cycles, you can have flow, momentum, right? Which is a sort of the derivative or the result of fund flows that can temporarily distort the big picture. And really, that's in a nutshell, that's essentially what happened. Now, to me personally, it is important to still have that macro overlay because I know the machine will pick up on all this stuff, but it gives me more conviction by understanding where we are in the economic cycle to see certain things. For example, the current rally, like as much as we have bullish trends in many places now, to me, these bullish trends are limited in time. So yes, at some point, your algorithm will, of course, flip back and tell us, yes, this is no longer a bullish trend, and it'll nail that. It always does because the trends will change. However, if I can contextualize that better with my own qualitative and quantitative overlay, understanding where we are in the economic cycle, then I am less prone to right now buy into very extended charts. Whereas if we were in a different economic environment, different part of the economic cycle, different interest rate environment, I would have no problem buying right now into these new bullish trends or bullish trends that are about a quarter old right now and have worked very well. That's important. Now, let me just show you, I think it's one or two more. Microsoft, same deal, right? We got a beautiful buy signal into a new bullish trend in the first half of April. Stock ended up rallying from, what is that, like 285 to 350. Same thing on C3 AI. That's a stock that a lot of people started looking into from the AI story. That thing turned into a bullish trend and ended up rallying from 17.5 up to 47. Again, very strong trends like that. So I'm going to, just for those people that are watching us in YouTube, I'm going to stop the screen share and I'm going to go back to just audio or audio and video, depending on whether you're listening to this on a different platform. So let's talk about some of the advantages and maybe some of the disadvantages as well of using essentially, I don't want to call it algorithmic trading because it's not automated, but it's systems stuff. Let's call it that way, indicators. Okay. Now, the list is quite long, fairly extensive, but here are some of the benefits of using indicators and more automated computer-driven models. Let's call it that way. Speed and efficiency is one thing, right? So if I think about an indicator, it can more quickly and more efficiently do something than me for the most part And a lot of that really just comes down to one very simple thing, which quite frankly, most of these things I'm about to go through are all rooted in one big difference between the machine and me, and that's emotions. So if you're the kind of person who's having a harder time managing emotions in the markets, most like 99.9% of us, by the way, do fall into that category, certainly myself included, then using an indicator or a process, particularly like the market rover, which gives us not only trends when we go into a new trend, when a trend ends and starts and all that stuff, but also gives us trades. It's just much less emotions are much more so kept at bay. The second part of that would be it eliminates biases, right? So like to me, as I just showed you before, I was very much bearish coming into the year, and even more so into the second quarter of the year, to for some things, not for everything. I should be very clear on that. We did actually make a big deal that we could see a pretty strong second quarter rally. I didn't think it'd be this strong, but I was, again, had emotional bias based on my macro overlay. The computer, my algorithm, the market rover doesn't care one bit what the emotions are. It just looks at data, right? So this is powerful for people at home managing their own portfolio, their own IRAs, their own investment accounts, and of course also for institutional investors who do this on a professional level. Discipline, again, I'm just mentioning different ways to saying the same thing, but it'll resonate. Consistency of discipline. More of a computer-driven model will adhere to very strict and predefined rules, ultimately strategies, so they're not susceptible to human error, fatigue, or distractions that can affect us as humans, and thus they're much more precise and, again, emotionless. And this consistency and discipline can lead to much better risk management and improve overall performance. And that's, again, factual in terms of the system, how much it kicked my ass in the first half, particularly the second quarter of 2023. Monitoring and sort of adaptability, again, saying the same thing in different ways. Again, a system will be much better at adapting to a different market. So if a market goes from bullish to bearish, and if my own analysis, which is both quantitative and qualitative, is lagging in certain data points, which it can, the system will adapt to this much more quickly. So again, it speaks for having algorithms and computers or indicators as part of a process. There is potentially reduced costs, right? And I'm not talking about execution cost, although that is certainly a factor, but just time, right? Time is energy, time is money. And if I can have a system do some of the heavy lifting for me, and I say some of the heavy lifting because I do want to touch on some of the drawbacks of it, then that's certainly good. And in general, really, I would summarize all these things, the advantages of using some of these systems, they're better at basically removing human limitations, right? They're removing human limitations. So again, time availability, physical limitations, individual biases, these things, technically, they can operate 24/7, continuously monitoring the markets, executing trades, depending on which markets you trade. I'm mostly a dollar investor, so I have certain time frames throughout the day when we do things. And ultimately, believe it or not, even scalability. If I look at our market rover, again, this is an indicator algorithm based analysis tool. It's scalable. It's infinitely scalable in terms of how many stocks and ETFs and currencies, whatever else it wants, bonds it wants to analyze. To me, I only have so much time and so much time I want to spend in my waking hours. Usually about 15, 16 hours at the office tends to be enough, or maybe a touch less, but yeah, 15. Whereas the computer can continue to go. So I think these are really important things. So those are advantages. And again, this is why the market rover really beat me hand over fist. And this all, by the way, should be a huge testimony to the market rover, to what it does and how well it's programmed. And so I guess I'm very proud of myself and my team that we've done that. I'm less proud of myself for having not listened to it in this particular instance. And mostly we do listen to it. In this case, it was more, again, it wasn't even so much not listening. It was really more, again, it was a timing difference. Whereas we did not think the markets would be able to react to flows and structural positioning, and quite frankly, more monetary ease or stimulus, essentially, to the extent that they did. So anyway, let's talk about some drawbacks, though. If I look at the landscape of investors on the professional level, and even some sophisticated individual investors for sure, I have yet to find one outfit, one company, or again, a sophisticated individual investor that does not use both to some extent. And as much as we have all those positive attributions for indicators and automated analysis, if you will, computer-driven analysis, the human mind from a can for right now, at least, and I can only speak for my process, right? Although I know a lot of other people's processes, and I would agree it's at the moment still the same. There is something to be able to go in there and say, no, this analysis right now might be jaded because the computer model is missing one big thing. Like, for example, like a prominent example would be, okay, so the computer model is giving me a buy signal on whatever, a stock, an ETF, a currency, whatever. But what it's not realizing is that, let's say in 3 days, there's a super crazy important Fed meeting, election, right? Those are the kinds of things where you have to take the indicator, the algorithmic tool that we have by its horn and say, listen, no, stop. That's great that you have a bias signal, but you know what? We have an event risk here, a known unknown. And a known unknown is essentially, as I said, it's an earnings report. It's we know the date, we know what's going to happen, we don't know the outcome. So it's known what's going to happen, what's the data. We don't know what the event is. We don't know what the outcome is, i.e., we don't know how markets react. So we can control that, and so that's something that's what we can't control. And here, this is equally par for the course for using a computer for decision making or our own just human mind, is for unknown unknowns, right? So those are your black swan events, if you will. Unknown unknowns. We don't know what we don't know, right? We don't know of an event that's going to happen, and we don't know what the outcome will be and how markets react. They're black holes. We can have those can happen all the time. So those we unfortunately can't control. The only thing we can control there is by being positioned properly, which again is where this is another benefit of using something like this. Like our market rover gives us both bullish trends and bearish trends. So if I'm diversified and I have some things that are bullish, I have some things that are in a bearish trend, again, that's another reason maybe why an algorithmic based approach would make sense. These are some of the pros and cons of using an algorithm. I'll end on one more, I think, important note in terms of why one would be wise to use both. There are so many different factors that go into analysis, and I have yet to find a system, and maybe it exists, although I doubt that it does, that can take every piece of information into account. There is stuff that is still better, in my view, analyzed by us. So if I'm managing a portfolio or managing a set of trade alerts, I like to have my input and see if I can marry that up as much as possible with what my computer is telling me. So the absolute best signals I get when both, in this case, the market rover, our trend following and trade algorithm, agrees with my overlay, and whatever my overlay is. Sometimes it's more structural based, meaning more intermediate term, and sometimes is a bit more macro based, which could arguably even have some things like fundamentals as part of the analysis, although that's even longer term. And again, the reason for that is because the more things we have lining up in the same direction, the better. If those people that use purely technical analysis will understand this as well, where you draw a line, you keep it simple, and then there's another point, another set of technical analysis that agrees with that line, and maybe a Fibonacci thing, and maybe a moving average, and maybe a blah, 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 whatever. This is, again, using single factor analysis, just technical, but that's what I mean. So if we can marry up our qualitative stuff with our quantitative stuff, at least in my experience over the past 24 or 5 years, that is something very powerful. So I just wanted to bring this across and hope it helps. Now, for any of you that want to use the market rover, which is, again, this algorithm or indicator that just kicked my ass, make sure you go over to thesteadytrader.com. So it's www.thesteady, markettrader.com, and you can go ahead and click on that website, and there's a button right there for Market Rover, and you can find out all about it. There's a great page you can click around and see all the features, and you can even inquire about more information on that tool there. That's it, folks. I hope it was helpful, and I hope everyone's getting through the summer months here. We're in the dog days of summer, as they say, and that's going to be even more doggy here over the next couple of weeks. But as we start heading into the early part of August, we should start slowly being able to see the end of the tunnel. I think the market is going to have a lot in store for us, so lots to talk about here throughout the coming weeks, regardless of summer being summer. Remember, the markets can get very volatile in the summer months. Don't be fooled. There is that distinct possibility, and maybe that distinct possibility will push through this year. We shall see. Thanks for listening, folks. www.steadywealthpodcasts.com is where you can watch and review this podcast and even access our YouTube shorts and other social media content. See you guys soon, and thank you for listening.